Welcome to vTalkInsight, Market Drivers Daily for March 13th, 2026. The closure of the Strait of Hormuz has turned into a full-scale oil shock, forcing equities, bonds, and currencies to reprice stagflation risk and higher volatility. Let's unpack how the geopolitics, the supply pinch, and the volatility spike are now feeding through global markets. Geopolitical tension around Iran and the Strait of Hormuz has moved from a headline risk to the central macro driver. Oil is holding around or above $100 a barrel, and markets are shifting from asking how big the initial shock is to how long the disruption will last. That duration question matters because the longer flows remain constrained, the more stagflation risk builds, particularly for Europe and energy-sensitive sectors, and the more pressure there is on valuations that still look optimistic about growth and earnings. The Iran war is now in its 14th day, with Tehran signaling it intends to keep the Strait of Hormuz effectively closed and hinting at opening new fronts if the conflict drags on. Only a handful of largely Iranian or very risk-tolerant tankers are making it through, and shipping activity has largely halted. Roughly 20% of global oil normally passes through this choke point, and current estimates suggest about 6.7 million barrels per day are offline, making this the largest oil supply disruption on record and leaving a growing backlog of tankers on both sides of the strait. Policy responses so far underline how constrained the toolkit is. Strategic reserve releases are already in play, but flow limits and logistics mean they only cover a few weeks of lost supply and cannot fully replace disrupted Gulf exports, particularly into Asia. Washington has eased sanctions to allow more Russian crude already at sea to clear, and a short-term waiver is giving Moscow the ability to sell closer to market prices rather than heavy discounts, boosting Russian revenues by an estimated hundreds of millions of dollars per day and highlighting how rivals can profit from the turmoil. Oil pricing now embeds a wide range of conflict duration scenarios. Brent has surged 30 to 40% in March, briefly pushing toward $120, and some forecasts see $147 to $164 if the strait stays shut for 3 months, with even 2008-style peaks discussed if disruptions persist into April. At the same time, commodity strategists still project average prices in the high 70s over the year, implying an expectation that demand destruction, alternative supply, and policy pragmatism eventually cap the spike, but not before higher gasoline and power prices bite into real incomes and push inflation readings higher. The macro fallout is visible across assets. U.S. Treasury yields have risen sharply, with the 10-year around 4.27%, as bond markets price persistent energy-driven inflation and push out expectation for the first fully priced Fed cut to the middle of next year. In Europe, the European Central Bank faces the risk of headline inflation rising toward 3% if the war persists, and there is now open discussion that it could even hike again if oil and the strait closure extend into June. While the traditional 60-40 portfolio is struggling as both equities and bonds sell off, and the U.S. dollar emerges as the dominant safe haven. Against that backdrop, energy stocks and oil majors such as Chevron, Occidental, and ConocoPhillips have been among the few equity winners year to date, while broader indices remain under pressure and commentators warn that equities still look complacent about a prolonged conflict. Beyond the headline oil price, the same geopolitical shock is now morphing into a broad-based supply chain disruption story. What began as an energy issue has turned into a logistics and input cost squeeze that touches everything from food to semiconductors. The key question for companies is not just what oil does, but how long shipping lanes stay impaired and how far higher freight, insurance, and materials costs can be passed on before volumes crack. Shipping through the Strait of Hormuz has largely ground to a halt, with thousands of vessels, including over 100 container ships and tankers, stranded or rerouted due to security and insurance constraints. Bunker fuel costs have doubled in just 10 days and now account for roughly a quarter of total freight costs, while war risk insurance premiums have jumped to around $3,000 per container for cargo transiting the region, feeding directly into landed costs for manufacturers and retailers. The disruption extends well beyond crude flows. Exports from Asia to Gulf countries have almost stopped, forcing factories to redirect goods to other regions, and key Middle Eastern air corridors have shut, cutting Asia-Europe air freight capacity and pushing companies into more complex and expensive workarounds. At the same time, protectionist steps by major Asian oil consumers, including export bans and prioritizing domestic fuel supply, are tightening availability for Western buyers, while shortages in helium and other commodities are lifting semiconductor memory prices and leaving Taiwan and other tech hubs particularly exposed. These frictions are starting to show up in corporate P&L dynamics. Packaged food companies look especially vulnerable, facing rising input and logistics costs at the same time as volumes soften and their ability to push through further price hikes is limited. Industrial and consumer exporters are absorbing higher freight, fuel, and insurance bills, and while order cancellations have not yet become widespread, many firms have shortened their planning horizons to just a few months and are juggling decisions about whether to rebuild inventories or run lean and risk stockouts. There are, however, signs of adaptation that offer a partial counterweight. Some Gulf producers are rerouting crude through alternative ports, such as Fujairah and Yanbu. Strategic reserve releases are providing limited backstop supply, and many companies have so far avoided major order cancellations despite cost pressures. Even so, Asia is already seeing mandated demand reductions and fuel rationing, and any deployment of naval mines could mean weeks before shipping lanes are fully safe again. So watch for the timing and scope of an international naval coalition, further moves in war risk premiums, tariff announcements from ongoing U.S. trade investigations, and early earnings warnings from supply chain intensive sectors as key markers for how deep this disruption runs. The combination of an oil shock, policy uncertainty, and supply chain stress is now feeding into a clear volatility regime shift. Implied volatility across assets has pushed to recent highs, even though index-level moves still look orderly compared with past crises. This tension between elevated volatility and only moderate price declines is central for risk management because it suggests the system is absorbing the shock so far, but could tip into a more disorderly phase if correlations spike. Equity and rates markets are both flashing higher uncertainty. The VIX has risen for a second consecutive day. U.S. Treasury volatility has jumped to a 9-month high, and bond markets have just seen one of their largest recent sell-offs as traders price out near-term Fed cuts. Benchmark equity indices, including the S&P 500, are on track for a third straight week of losses, while European futures and Nasdaq futures remain under pressure, and European risk premia sit near 20-year lows despite geopolitical and credit concerns, pointing to a potential gap between volatility signals and valuations. Safe haven behavior looks different from previous geopolitical shocks. Traditional refuges like long-duration government bonds and gold have not rallied as strongly as history might suggest, while oil itself and the U.S. dollar have become the primary safety trades. The dollar has climbed to its strongest level since May. The euro has dropped to multi-month lows, and other major currencies such as the pound and yen are under pressure, reinforcing the message that a strong dollar and elevated energy prices are now the key macro headwinds for global risk assets. Under the surface, positioning is starting to adjust, but has not yet reached capitulation. Investor flows have rotated away from technology-heavy vehicles toward energy, industrials, and materials, and risk managers are pushing for portfolio de-risking as volatility indices jump and margin requirements rise. At the same time, derivatives markets show high option premiums, making volatility selling strategies look attractive for some, and there is growing concern that a further rise in market-wide correlations could trigger forced deleveraging and a broader risk-off move across assets. Balancing this is a credible resilience narrative. The U.S. economy is still seen as running above trend and able to absorb the current shock unless conflict proves prolonged. History shows many oil-driven volatility spikes fade within weeks, and credit spreads and default rates remain contained outside pockets like private credit. That said, with markets now focused on upcoming core PCE data, the next Federal Reserve meeting, and a busy earnings slate from names such as Lululemon, Macy's, and Micron, the scope for policy or guidance surprises is high. So watching how volatility behaves around these catalysts will be critical for gauging whether we stay in a controlled repricing phase or transition into something more disorderly. To wrap up, the Strait of Hormuz closure has turned into a genuine oil and inflation shock, forcing bond markets to price out early rate cuts, while equities still walk a fine line between resilience and complacency. Supply chains are feeling the strain through stalled shipping, higher freight and insurance costs, and pressure on inputs from food to semiconductors, with corporate margins and earnings guidance the next likely transmission channel. Volatility has clearly broken higher across oil, rates, and equities, and the U.S. dollar has emerged as the dominant safe haven. So the key watch points now are the duration of the Strait disruption, upcoming inflation data, central bank communication, and any sign that earnings or positioning shifts push markets from controlled repricing into a more disorderly phase. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.